Why is it that when the market moves in their favor, many traders still struggle to hold their positions long enough to maximize profits? This challenge goes far beyond trading strategies or technical signals. It stems from hidden psychological factors, a lack of patience, and the invisible pressure of price fluctuations. In this section, we will explore the deeper reasons why riding profits can be so difficult, from survival instincts rooted deep in the subconscious to the way market structure and capital flow influence exit decisions. Understanding these forces is the first step toward turning a temporary edge into lasting profitability. Part 1. The psychology of protecting profits. When an account moves from red to green, many traders believe the pressure is gone and the win is secured. But the truth on the trading floor is far more ruthless. The moment profits appear is often the moment a new kind of pressure begins. Instead of enjoying the feeling of victory, traders often slip into a state of fear. Fear that the beautiful number on the screen will vanish. This fear is quiet but powerful, strong enough to make them exit too early and leave most of the potential on the table. Loss aversion, when the fear of losing outweighs the desire for gains. In behavioral finance, loss aversion describes a natural human tendency. We hate losing roughly twice as much as we enjoy winning. This plays out vividly in trading. When a position is in the red, traders are often willing to wait for hours or even days, hoping the market will return to break even. But when a trade is in profit, patience disappears. A minor pullback can trigger an immediate exit. Wall Street is full of stories about traders who nailed the trend early, entered perfectly, but walked away far too soon simply because of psychological pressure. They locked in profits the moment they appeared, forfeiting the market's full reward. This mistake rarely stems from a lack of technical skill. It comes from a survival instinct wired into the brain, urging them to protect what they already have. The survival instinct on the market. On Wall Street, there's an old saying, "You'll never go broke taking a profit, but you'll never get rich that way either." This is the paradox of trading. The survival instinct helps traders avoid sudden collapses, but it also limits their ability to capitalize on major trends. When a position is in profit, the brain switches to asset protection mode, a mechanism evolved when our ancestors had to guard scarce food resources. In financial markets, food means profits. And instead of being threatened by predators, those profits are threatened by price volatility, something that cannot be avoided. The trauma of sudden reversals. Nothing haunts a trader more than the memory of a winning trade that turned into a loss. The feeling of "I should have" is a deep scar in the trading mind. These experiences damage not only confidence, but also get etched into the subconscious, making traders overly cautious in future trades. They exit prematurely just to avoid reliving the same pain. One well-known story from the Chicago futures floor involves a trader who caught the bottom of a WTI crude contract and quickly gained more than 30% in just a few hours. But when prices made a mild pullback, he exited. The next day, crude rallied to nearly double the profit he had taken. The lesson is clear. Fear from the past can become the chain that locks down your future. The gap between theory and reality. In theory, the let your profits run strategy makes perfect sense. In practice, the market is a psychological chess match where every candle, every price swing is a jab at the trader's nerves. When looking at the chart, traders do not just see price, they see unrealized dollars fluctuating. This creates constant pressure because unrealized gains are not real money, and they can disappear in an instant. The illusion of control. Taking profits gives traders a feeling of control. By clicking the close button, they believe they are actively determining the outcome. In contrast, letting a trade run means handing control over to the market, and that makes many feel uneasy. They would rather take a small but certain amount than tolerate uncertainty. But this is the trap. Closing early might make you feel safe, but over the long run, it will cut deeply into your performance. A sound strategy requires the ability to endure price swings even when you're ahead, seeing profits as your own money. Another psychological driver that makes holding winners hard is that traders tend to treat unrealized gains as money already in their pocket. When the price dips slightly, they feel as if they are losing real cash. This is an illusion. The money never actually belonged to them until the position is closed. But once the mind ties emotions to the number on the screen, any decline feels like a loss. Lessons from cold heads on Wall Street. Legendary money managers do not hold winners based on feelings. They follow principles. They define profit targets using data, trend analysis, and volatility measures, not emotions. George Soros once said, "It's not whether you're right or wrong, but how much money you make when you're right." To capture the full value of a good trade idea, you must be ready to withstand the market's natural shakeouts. Probability thinking, the key to relieving pressure. One of the best ways to overcome the urge to protect profits too early is to think in terms of probability. Each trade is just one sample in a much larger series. No single trade is more important than the system as a whole. If you consistently cut winners short, your system's expected return will shrink no matter how high your win rate is. Conversely, letting trades run far enough means a few big winners can offset many small losers. Winning also requires discipline. Holding winners is not just about staying in a profitable trade. It is about sticking to your plan when emotions tempt you to do the opposite. On Wall Street, the traders who survive the longest are not those who always make perfect entries, but those who manage their emotions best. When the green on your screen starts to feel heavy, remember that discipline, not an early exit, is what keeps you in the game. Part 2. The market never moves in a straight line. One of the hardest truths for traders to accept is that the market never moves in a perfectly straight line. Price action is not a constant climb or an unbroken fall. It is a series of advances and pullbacks, rallies and corrections, surges and hesitations. Even in the strongest bull markets, you will find sharp drops. Even in the most brutal bear markets, you will see sudden spikes upward. This is the market's way of testing conviction, shaking out the weak hands, and rewarding only those who have the patience and discipline to sit through the noise. For traders who struggle to hold on to winning positions, this reality becomes a psychological battlefield. The moment you enter a trade and it moves in your favor, your mind wants to lock in the gain as quickly as possible. The screen flashes green, the profit counter ticks upward, and a voice inside whispers, "Take it now," before it disappears. This fear is not irrational. It is rooted in experience. Every trader has watched unrealized profits vanish in a blink when the market reverses. The memory of those moments makes you trigger happy, eager to secure whatever is on the table. However, the problem is that successful trades often require enduring these natural pullbacks. The market's rhythm is not designed to reward impatience. Institutions accumulate and distribute in phases. They rarely push price in a single uninterrupted direction because such a move would reveal their intentions and invite competition. Instead, they scale in, allowing the market to breathe, often creating retracements that feel like reversals to the untrained eye. If you cannot accept this ebb and flow, you will always cut your winners short. The irony is that most traders give their losing trades more room than their winning ones. They tighten stops when they are up and loosen them when they are down. This inverted logic destroys long-term profitability. By locking in small profits and tolerating large losses, you tilt the odds against yourself in a game where the odds are already unforgiving. The market's choppy path also creates the illusion of danger. A strong trend can feel like it is about to end at any moment because of minor fluctuations. A trader who does not understand market structure might see a normal retracement as the start of a reversal. The moment a candle closes against their position, panic sets in. Instead of seeing the pullback as an opportunity to add to a position or simply sit tight, they exit prematurely, only to watch price resume its original direction moments later. This experience not only costs them money, but erodes confidence, making it even harder to hold future trades. Patience in trading is not passive. It is an active decision to trust your analysis and your plan in the face of uncertainty. It means understanding that every trade is a probability play, not a guaranteed outcome, and that the path to your target will rarely be smooth. It means embracing the idea that discomfort is part of the process. The most seasoned Wall Street operators view pullbacks as a necessary component of healthy price movement. They know that without them, trends cannot sustain themselves. In fact, the absence of pullbacks can be a warning sign that a move is overextended and vulnerable to a sharp reversal. They position themselves accordingly, not by predicting every swing, but by aligning with the bigger picture and letting time do its work. For the retail trader, this perspective is difficult to adopt because of two factors: a lack of trust in their edge and the emotional weight of unrealized profits. Without a tested system, you have no reason to believe that the market will continue in your favor after a pullback. Without emotional discipline, you cannot resist the temptation to cash out at the first sign of trouble. The combination leads to chronic underperformance, where your average win is smaller than your average loss, and your account equity drifts downward despite a high win rate. The truth is that in trading, you are often paid for waiting. Not waiting idly, but waiting intelligently, anchored by analysis and guided by a plan. The market will not hand you a straight line because straight lines are predictable, and predictable markets cannot exist for long. Instead, it will move in waves, each one designed to test your patience and your resolve. If you can endure the noise without flinching, you will not only capture larger profits, but also develop the psychological resilience that separates the professionals from the amateurs. Part 3. Pressure from personal expectations. In the world of professional trading, expectations are a double-edged sword. On one side, they serve as a driving force, motivating traders to strive for bigger wins, faster results, and the feeling of progress. On the other side, they create a psychological pressure that can sabotage decision-making, especially when holding winning positions. The human mind struggles to remain patient when the market moves in our favor, because personal expectations whisper in the background, urging us to take the money now before it disappears. This pressure is not simply emotional. It is deeply rooted in cognitive biases, past experiences, and the fear of regret. Personal expectations often develop from three primary sources: personal goals, past performance, and external influences. Each source feeds into the mental framework that dictates how long a trader is willing to hold a profitable position. For example, a trader who sets a goal of making $10,000 in a month may feel an immediate urge to close a trade once it has contributed a significant portion toward that target, even if the market shows potential for further gains. The profit on the screen feels tangible, but the future gain is uncertain. This tension between the real and the potential is where most traders succumb to early exits. The second source of expectation comes from past performance. Traders often anchor their decisions to previous experiences, especially memorable wins and losses. If a trader once saw a large profit vanish because they held too long, the emotional memory of that event can override objective market analysis in future trades. The mind becomes risk-averse when it recalls the pain of giving back profits, even if the current trade has a fundamentally different setup. Conversely, if a trader has experienced a quick, massive win, they may set unrealistic expectations for future trades, leading to impatience when the market does not deliver the same speed or magnitude of return. External influences form the third pillar of personal expectation pressure. These include the opinions of fellow traders, the performance of friends in the market, and even the highlight reels of social media. In an era where traders constantly see others posting screenshots of massive gains, the subconscious begins to compare. This comparison can create an unhealthy urgency to lock in profits just to match the perceived success of others, regardless of whether the trade has reached its optimal exit point. The pressure is amplified when a trader shares their positions publicly. Every moment holding a winning trade feels like being under an audience's watch, and the fear of that win turning into a loss can push them to exit prematurely. The interplay of these expectations has a powerful effect on how traders handle profitable trades. A market move in the trader's favor can trigger two opposing thoughts almost simultaneously: the desire to maximize the gain by letting it run, and the fear of losing the gain by holding too long. Personal expectations tend to tilt the balance toward fear, especially if those expectations are tied to short-term goals or recent emotional events. This dynamic often creates a psychological trap. Traders begin justifying early exits with seemingly rational reasons. The market looks like it's slowing down, or it's better to take what I have than risk losing it. While risk management is a core principle of trading, the decision to exit early under the influence of expectation pressure is rarely rooted in pure analysis. Instead, it is a defensive move to protect not just capital, but the emotional comfort of seeing a realized profit. Breaking free from the grip of personal expectations requires a shift in focus from outcome to process. Professional traders operate with a clear trading plan that specifies entry, stop loss, and take profit levels before a trade is initiated. This structure acts as a safeguard against emotional interference mid-trade. When expectations begin to rise in the mind, the trader can rely on the plan rather than the momentary impulse to lock in gains. One of the most effective ways to reduce expectation pressure is to detach performance goals from individual trades. Goals should be measured over a large sample size of trades, not the result of a single position. This approach mirrors the mindset of institutional traders, who view each trade as just one iteration in a long series, where adherence to strategy is more important than any single outcome. In essence, the challenge of holding on to winners is not just about market volatility or price patterns. It is about the internal storm created by personal expectations. These expectations shape perception, influence risk tolerance, and can turn a well-planned trade into a prematurely closed position. Mastering this pressure means developing emotional discipline, aligning goals with long-term consistency, and trusting the process over the immediate gratification of locking in profits. Part 4. The fear of sudden market reversals. One of the most persistent and deeply rooted challenges that traders face when holding on to winning positions is the constant fear that the market will suddenly reverse against them. Even when a trade is working perfectly in their favor, the human mind rarely feels secure. Instead of enjoying the process of profit accumulation, most traders subconsciously search for signs of danger. Every small retracement, every red candle, every dip in momentum becomes a potential omen of disaster. This mental habit is a product of evolutionary survival instincts, combined with the unforgiving nature of financial markets, where a single reversal can indeed erase hours or even days of patient gains. This fear often intensifies the more money is on the table. A trade that is just a few points in profit may not trigger much anxiety, but once the position is deep in the green and the unrealized profit is significant, the stakes feel higher. Traders begin to visualize losing that profit as a form of loss, even though it was never locked in. In psychological terms, this is known as loss aversion, the tendency for losses to weigh heavier than equivalent gains. A trader who has a $10,000 profit on paper may feel far more pain imagining it shrinking to $7,000 than pleasure if it grows to $13,000. The market's natural rhythm adds fuel to this anxiety. Price action is rarely smooth. Even in strong trends, there are constant pullbacks, consolidations, and temporary shifts in momentum. To an experienced market observer, these fluctuations are healthy and necessary, but to a trader holding a live position, they can feel like the first signs of an impending reversal. This feeling is amplified in shorter time frames, where noise dominates and every small fluctuation looks like the beginning of a major move in the opposite direction. Fear of reversals also stems from lived experience. Every trader has endured situations where a strong winning position collapsed suddenly due to a surprise event, news headline, or shift in market sentiment. Those scars remain in memory, making traders hypervigilant and overly reactive to normal market behavior. Instead of trusting the trade plan, they start reacting emotionally to every small move, often closing positions prematurely in an attempt to protect profits. Ironically, this defensive behavior can be just as damaging as letting a loss run, because it prevents traders from ever fully capturing large moves, the very moves that are essential to long-term profitability. Institutional traders often combat this fear by relying on a predefined exit strategy supported by back-tested data. They know in advance how much of a pullback they are willing to tolerate and what signals will trigger an exit. By following a rules-based system, they remove much of the emotional decision-making that fear exploits. Retail traders, on the other hand, often lack such structure. Without a clear plan, they rely on gut feeling, and fear thrives in uncertainty. Ultimately, the fear of sudden market reversals is not something that can be completely eliminated, but it can be managed. It requires a shift in perspective, Understanding that reversals are an inevitable part of market movement and that the key to long-term success is not avoiding them entirely, but managing risk and letting the probabilities play out. The traders who can hold through healthy pullbacks without panicking are the ones who consistently extract the most value from their winning trades. Those who give in to fear will continue to cut winners short, leaving the majority of potential gains unrealized. Part 5. Lack of a clear exit strategy. One of the most overlooked yet critical reasons traders struggle to let their profits run is the absence of a well-defined exit strategy. Many traders put significant effort into planning their entries, but treat exits as an afterthought, relying on gut feeling, random price levels, or emotional impulses. Without a predetermined framework for taking profits, every tick on the chart becomes a mental battle between greed and fear. This lack of structure leaves the trader vulnerable to overreacting to short-term price fluctuations and making decisions that undermine long-term profitability. A clear exit strategy is not just about setting a target price. It is about establishing a set of rules that dictate when and how profits will be locked in, based on the market's behavior rather than emotional impulses. This can include scaling out of positions at certain milestones, trailing stop losses to protect gains, or using technical signals such as momentum shifts or volume changes to signal the right time to exit. Without these rules in place, traders often find themselves in a cycle of second guessing, holding on too long in hopes of squeezing out extra profits, or exiting prematurely at the first sign of retracement. On Wall Street, professionals understand that the exit is where money is truly made. A flawless entry means little if the trade is exited at the wrong time. The market's natural volatility ensures that there will always be pullbacks, consolidations, and shakeouts before a larger trend completes its move. Traders without a plan tend to misinterpret these normal fluctuations as reversals, cutting their winners short. This behavior not only limits profit potential, but also skews the risk-to-reward ratio in a way that makes consistent success nearly impossible. The solution lies in building an exit plan with the same level of precision and discipline applied to entries. This means determining in advance how profits will be taken under different market scenarios. Will you exit at a fixed multiple of your risk? Will you trail your stop using a moving average, ATR, or key technical level? Will you scale out gradually to capture both short-term and long-term gains? These decisions should be made before the trade is placed, not in the heat of the moment when emotions run high. A trader who enters the market with a clear roadmap for exit can detach from short-term price noise and focus on executing the plan. This clarity removes the burden of constant decision-making under stress and allows the market to do the heavy lifting. More importantly, it reinforces the discipline that separates professional trading from gambling. Without it, even the best trade setups will fail to reach their full potential, and the trader will remain trapped in the cycle of cutting winners short while letting losers run. Part 6. Solutions for successfully holding profits. To overcome the psychological and strategic challenges of holding profits, traders must develop a disciplined framework that removes emotional decision-making from the process. First, define a clear exit strategy before entering any trade. This includes setting profit targets, trailing stops, or time-based exits that align with your trading system. By committing to these rules in advance, you reduce the temptation to close trades prematurely due to fear or impatience. Second, learn to scale out strategically. Instead of closing the entire position at the first sign of profit, consider taking partial profits while allowing the remainder to run. This approach locks in gains while giving you the psychological comfort of having secured a portion of your profit, making it easier to hold the rest for larger moves. Third, embrace market fluctuations as a natural part of price action. No trade moves in a straight line, and temporary pullbacks do not always signal a reversal. Use objective tools like moving averages, trend lines, or momentum indicators to validate your decisions, rather than reacting emotionally to every small retracement. Fourth, work on your mindset. Shift your focus from protecting a small profit to maximizing trade potential within the rules of my plan. Review your trade journal to identify patterns where you exited too early and calculate the potential gains missed. This data-driven reflection can reinforce your discipline. Lastly, accept that no method will capture every last dollar of a move. Your goal is not perfection, but consistency. Holding profits successfully is a skill that combines technical strategy with mental resilience, and mastering it can be the difference between average and exceptional trading performance. If you found this insight valuable and want to develop a stronger trading mindset, subscribe to the Trading Mindset Lab channel. Together, we will sharpen your skills, strengthen your discipline, and help you approach the market like a true professional.